Good morning and welcome to the Killik podcast for Friday, the 22nd of January. So another very volatile week. We're just revisiting what's been going on month to date. So financial conditions have materially tightened. So ability to get loans, the cost of those loans, the cost of the trade-weighted dollar index, all making doing business in the United States more difficult. So it's equivalent of around 4 rate rises of 0.25%. And as you can see here, this is the Bloomberg Financial Conditions Index. You can see that tightening there. At the same time, demand has continued to decelerate. We continue to see more pressure on commodity capex, and that's feeding into the industrial sector. And we're not really seeing any reduction in oil production, and the IEA this week were warning that oil markets could drown in oversupply. Equally, emerging markets are continuing to see pretty poor GDP numbers, although we did see this week a disaggregation of the Chinese GDP number, and that tertiary or consumer services sector is starting to stabilise, which is good news for their economy and what they're trying to do in terms of transitioning it. Finally, consumers appear not to have spent their oil windfall. So all of this takes GDP in the States down from the 2 to 2.5% growth rate that it was operating at, down to an area where you're getting into that level of growth where it's sort of 0.5% to 1.2%, where you'd stop adding jobs, which is a sort of material effect for the overall economy. And we've got to be very careful about that. Equally, the global GDP growth rate seems to have slowed, perhaps 0.5 percentage point, but that typically has around a 10% effect on EPS, which is why we're seeing downgrades to earnings expectations. So as a result, the market needs to react to that, and that's what they've been doing. So we've seen a markdown in stocks. We're now around 13% below the high on the S&P, as you can see here, in response to that EPS downgrade. So we're now into the sort of central bank period where we had the ECB today, we'll have the Fed next week. Sorry, we had the ECB yesterday. And the ECB are trying to get back in front of the curve and arrest this deflationary fear that's in the market. And they didn't really act in December as fast and as hard as people had hoped. So very strong language from Mario Draghi yesterday. So the power, the willingness, determination to act, no limit to how far we're willing to deploy our instruments. So the market's really expecting some fireworks in March. And as a result, we saw bond yields fall in Germany yesterday. So our portfolio strategy continues to try and look at the root cause of a lot of this volatility across all the markets. And we think it is a lot of industrial disruption that is causing a lot of it. So you look at the oil price, big effects from shale, big effects from the sort of efficacy of alternatives that's changing OPEC behaviour. We're seeing similar changes of behaviour in the retail or the auto sector. So all this change is also creating difficulty in terms of forecasting. So GDP numbers, consumer spending numbers are now potentially less reliable. So we see this market as having close similarities with the late 1990s, where bond yields stay very low because of the disequilibrium of growth rates across the developed and the emerging world. And you see those companies that are able to grow in a low growth environment being bid up in terms of their multiple. So next week we'll get a lot of reporting in terms of those types of stocks. We've got Apple, we've got Johnson & Johnson Tuesday, we've got Boeing, EMC, Facebook, PayPal, eBay, all on Wednesday. Thursday, Diageo, Microsoft, Amazon, Visa, Harley-Davidson, Western Digital. And Friday, we've got Whirlpool. Just focusing on 3 very quickly. Apple, they've been very weak into their numbers. Concerns over iPhone sales are slowing down. I think we feel that this is a reasonable opportunity to buy some stock. We've got a 4-inch iPhone in April and the iPhone 7 launching in September. We also feel that the valuation is extremely compelling on an 11% free cash flow yield. We can look through the short-term volatility as the company tries to go towards a leasing model. We think they can re-rate that stock and people can start looking at it as a service platform, which will command a much higher multiple. We also feel that they can grow their user base from here and add additional services onto that platform. So pretty positive about that, despite the short-term volatility we're seeing through quarter-on-quarter iPhone sales. In Visa, we continue to like this secular growth story, that cash to digital payment story. We think that there's more scope for earnings increases following the Visa European acquisition. It's important to remind people that Visa Europe was owned by a consortium of banks who were owners as well as users, so the revenue opportunity wasn't maximised. We feel that Visa's net revenue could grow 3 times on that Visa Europe part of the business, and so the conservative numbers in the market have plenty of cushion in terms of earnings achievability. We've also got Amazon reporting. Much of last year's very strong share price appreciation was through earnings growth rather than the re-rating of the shares, so the re-rating was only around 20%. We think the multiple on Amazon is still very reasonable if you disaggregate the business. So Amazon Web Services, the margin has grown from 17 to 25% over the last few quarters, and putting that on 20 times earnings, you've got a $75 billion market value. Then you look at retail margins around 8%, you can put the entire business on a 2017 multiple of sort of high teens, which I think is really very reasonable for the dominance that this company has on a global basis. So thanks for listening. Have a good weekend.